Chapter 8 is talking about the central banks. So it starts off with the Fed. So the Fed is the Federal Reserve that is basically our central bank of the United States of America. And they are kind of the ones who govern our monetary policy and make changes to interest rates and things that need to happen that can kind of spur the economy. It talks about a few definitions of things. So we've got the real bills doctrine. So central banks would lend money to commercial banks if those commercial banks can use the funds to support the real economic activity. So I think to think about that, like if they can in turn loan it out to small businesses or to consumers that again are going to help spur the economy, then the Fed is going to do that. Because again, it just is creating that money flow. Think of our last chapter, we talked about the supply of money. It's just increasing the supply of money. The Federal Reserve has 12 banks that are across the country. And it talks about the New York Bank being one of the bigger ones, but they are across, they're in Cleveland and Boston, Philadelphia, Atlanta, Kansas City, San Francisco, Minneapolis, and Chicago. So I think that's all of them. But there's a slide in your PowerPoint that shows you those as well as in the textbook. The discount rate is the interest rate that the Federal Reserve charges on the loans that it makes. So that's normally going to be the lowest loan. So those banks are going to borrow from the Fed at a low rate, and then they would use their own policies to charge out to the consumers or to the small businesses or big businesses that borrow from them. The Federal Open Market Committee is a committee within that Federal Reserve, and it's responsible for setting the monetary policy. Then it gets into the structure of it, which, to be honest, is actually kind of news to me. I didn't completely realize that the chair of the Federal Reserve is appointed by the president. So like our current chair does not even have an accounting or an economy type finance, any type of background. He's actually an attorney. So that is interesting. I just would have assumed that you had to be like a chief financial officer level person, that had banking experience and finance experience. But that is actually not true. It's just an appointment by the president and then a confirmation by the Senate. And then the textbook gets into a little bit about, like, it doesn't get into the House of Representatives. The House of Representatives are more like for the people. The Senate is a smaller group that is a little bit more political in nature. So that was kind of news to me. Then there's a board of governors, and those board of governors serve for 14 years, and they're non-renewable. So that's kind of like maybe like towards the end of their career, but then they'd be done after those 14 years. And then what they do is they kind of control the day-to-day operations of the Fed and set the budget and control those operations and make sure everything's running smoothly. They also oversee the commercial banking industry, so that if there's mergers or acquisitions, that's going to be the group of people who approve those, because sometimes you'll hear of things getting turned down because it would create like too much of a monopoly, if I can say that, a monopoly. So that they would be the ones to look at that to say if that seems like a good fit for our banking industry. And then set the monetary policy. And we'll get a little bit more into how that monetary policy is set by the Fed in a future chapter. Then there's, again, the district banks, so that there's 9 board members that they come from member banks within that district, and then they're to represent the district that they're coming from. And again, they would be bringing hopefully the public interest into, the area that they're at, kind of what are they facing in their economy. Then there's the Federal Open Market Committee, and the Federal Open Market Committee meets periodically, and they bring this beige book, or they prepare this beige book. And in that, so I guess it's 8 times a year. So they prepare this beige book 8 times a year, and it describes the current status of our business conditions and the U.S. economy as a whole. Then we get into their responsibilities, their functions, and then the balance sheet. So the responsibility of the Fed is to oversee our financial market. So they are regulating the, the banks and the, like our finance markets, as well as some of our insurances that get into some of the, savings accounts that the insurance companies offer, as well as like your local community credit unions. And then they're also a fiscal agent of the Treasury. So they are going to handle all of the payment of the bonds. So like the government can issue out local, the federal government can issue out short-term bonds, long-term bonds, bonds for specific purposes. So the Fed monitors all of those. So the book kind of talks about, back prior to everything being so computerized, that was a lot of work. It was a lot of, maintenance to record these transactions, to pay interest, to collect the money, to pay the money. Now everything's a lot more computerized, but they do still handle all of the issuing and the paying of interest of the government bonds that are out there. They also handle consumer protection. So we have a couple different laws that you probably learned in business law and ethics. There's the Truth in Lending Act and then Regulation Z. So those acts are trying to protect consumers who are out to get loans. So the Regulation Z says that all the terms have to be disclosed. So you have to know the length of the loan, the interest rate you're paying, can you pay it off early? All of those terms need to be disclosed to you as a consumer. And then the Truth in Lending Act kind of protects against discrimination and some other things. Ultimately the Fed would be responsible for that. This would be one of their duties. Then they also have the preparation of economic information and to be able to distribute that to the people who need it. So again, these different members from these 12 different districts are coming together to talk about what they're seeing in their little corner of the United States, what economic developments are happening, and gathering that data and bringing it back to one central place where then it can be used to make decisions that, again, impact our monetary policy. And then the Fed's balance sheet. So the balance sheet of a bank is very strange. So, they give you an example of that on page 177. So kind of look that over. But there are a variety of different assets and liabilities. I think what is kind of weird about it is that then things that you would think, well, gosh, that almost sounds like it should be an asset, is a liability, and maybe something that you think of that sounds like that should be a liability is an asset. So the banks kind of work the opposite of what we would think of as consumers. But what on there, to just kind of go over some of the major ones, their largest asset is their securities. And those securities are the government bonds, bills, notes. And then they also have, since our past mortgage crisis, they have also gotten involved in buying those privately issued mortgage-backed securities. So if you know anything about what happened during our mortgage crisis, 8 years ago or however many years ago, I want to say 8 years ago. But what happened was that there was money. So we have these mortgage-backed securities that were being bought and sold in the stock market. So people like you and I, actually in my 401k, I had some investments in those. So I'm investing money in this pool of funds that's being loaned out to consumers. Well, when that pool of money got big, they started to reduce the standards to get a mortgage. So instead of having to have 10% down, you could get 0% down and still get a mortgage. Some of them were even letting you borrow, like with a home equity loan, you could borrow up to 110% of your house. And again, the reason those things happened is because of these mortgage-backed securities. There was so much money in them that they had the ability to do it. Well, the problem with that is then you're lending to people who maybe don't completely even understand what they're getting into, and you're lending them too much money. And then some of them were interest-only loans, like with those ARMs. So like you pay interest only for 5 years or for 10 years. And then all of a sudden the regular loan payment starts and then they can't afford it. So they're going 10 years making this interest only. And then boom, this large payment comes in where you got to start paying the principal. And that's how a lot of people backed away from those mortgages. So then once that started, the real estate market pricing dropped. Then people were underwater in their mortgage, so their mortgage is more than their house is worth, and they just walked away. So all of that kind of started though because of those mortgage-backed securities. So in order to kind of fix that, because then everybody bailed on those because they were losing, the government ended up buying a lot of them. So then the government was able to kind of keep some of that money in the pool to loan out, but we've gotten a little stricter with who we give mortgages to. But I didn't realize that also, that they had gotten so heavily into that security market, but they did after the mortgage scandals and crises. Then there's repurchase agreements where basically a person sells the treasury bond or bill back to the government and guarantees to pay back in like 5 years or 10 years or something like that. So it's kind of like a repurchase agreement. So they're going to buy it back, but then they'll get their money at the end. Then there's term auction credit, where they're going to kind of auction off their available funds to the banks, the best bank that's available. And then again, the hopes would be that that bank would then loan that money out to businesses and to consumers. They also hold gold. I mean, there used to be a time where our currency was printed based on the gold that the government held. Currency is no longer gold backed, but we do still hold some of the gold in our treasury. Then there's coin. And the coin would be anything that gets issued coin-wise, is going to be an asset initially to the Fed, and then it's also a corresponding liability though too. And then discount loans would be when a bank is bringing the loans that they have to the Fed to get more money so that they can increase their loans for future loans. So that's a discount loan. Then we have the items that are in process of collection. So then those are down. So those are in our asset section still. And those are ones where, say we're making a deposit. So say I make a deposit at my bank and it's PNC, and the check was written from a bank on, Charter Bank or just a whole different bank. So when that bank deposits the money, it'll go through the Federal Reserve and then go over to PNC. So there's always a period of time where there's money just in the Federal Reserve. They call that in float because it's just in between the two banks. Then there's currency outstanding, so the currency that we as consumers hold in cash and that banks have in their drawers. There is the Treasury deposits, because again, the Fed is the U.S. government's bank, so all of their accounts are drawn on the Federal Reserve, so that all of the government's income is in there, or money is in there. And I think those are probably the most important ones that I kind of had highlighted. Then the textbook gets into all the different banks across the world, or the big ones across the world. So we've got the Bank of Japan. So the Bank of Japan is an independent bank, but it maintains a close contact with the government. And its responsibilities are issuing out the banknotes, or the bonds that the Japanese government issues. And they also have a responsibility for financial market stability. So they are monitoring their commercial banks, both off-site, and then they actually go internally and audit them as well, because they want to make sure that they're safe and they're sound for investments. They too manage their monetary policy. Japan tries to keep inflation as low as possible. They actually have a zero inflation rate policy, which is somewhat challenging to maintain, but their goal is to try to keep it as low as they can. They talk about, if you think about how we correct some of that sometimes, they reduce their interest rates on savings, which should encourage spending. But because the Japanese culture is a very savings-oriented culture, then that doesn't always work for them. So sometimes then when they reduce those rates, they actually reduce their spending because now they're not making as much. So it's like almost the reverse of what maybe happens here in the United States. Then there's the Bank of England. So the Bank of England was initially set out to create a bank that would have a monopoly over all of the bank notes that were issued, and then the individuals in the community would be the investors into those notes, and then the bank would loan the money out to the government. So the people would buy notes that the government or that the bank issued, they pay interest to the people, and then they'd lend the money to the government, who would pay interest to the bank. So they are really the bank over the entire United Kingdom, though, not just the country of England. And they also do cover their monetary policy, and their goal is to keep inflation at 2% a year. And then they also have agencies. They have the Financial Conduct Authority to protect their consumers, and the Prudent Regulatory Authority to protect the banks, the commercial banks. And then the European Central Bank, that was created in preparation of issuing the euro. So it was created in 1998, and the euro was introduced in 1999. And there's currently 19 countries that use the euro as their main form of currency. And the structure of the European Central Bank is that they have a governing council, they have a general council, and they have an executive board. So their governing council meets regularly to plan the monetary policy and kind of discuss the operation of the bank, or the central bank as a whole. Then their general counsel is responsible for any of the transitional issues when countries want to come in and start using the euro, because there's several countries that could still use it that have not chosen to yet. So as those countries maybe transition over, that general counsel would help them with any issues that they have. And then their executive board monitors the day-to-day operations as well as makes the monetary policy decisions. And then their monetary policy, again, is a little bit different because they have different nations. Like I said, there's 19 nations under their bank. So they have a little bit more complex of a situation because they have to monitor all of those. And they govern the foreign exchange operations. They want to make sure that the euro doesn't lose value in comparison to other currencies. So they'll actually do a unilateral intervention, which is to buy and sell the euro like in the market, if that would help to keep that value high. And like right now, the euro is higher than the dollar. So a lot of times that makes it more appealing for European people to come over to the United States to vacation, because the euro dollar has more buying power over here. So they can get a nicer hotel, they can go to nicer restaurants, they can pay more at shopping, because again, they have that difference in the euro dollar. So we benefit a little bit from that side of it. They also handle the payment system, which would just be the transaction with the various banks in euros. And then they hold the reserves for all 19 countries. Then the Bank of Canada, the Bank of Canada is headed by the governor of the bank, and he's the CEO of the bank, and he's appointed by the Prime Minister for a 7-year term. They too govern the monetary policy of the Canadian government, and they mostly focus on 2 major policies, which are the flexible exchange rates. Again, they want to make sure that the Canadian dollar is not losing value, and then inflation control. They'd like to keep it between 1% and 3%. And the Canadian dollar is very comparable to the US dollar. I mean, sometimes it's maybe like $1.05 or like 95 cents or something like that. So it's always pretty close to us. And then really, I think though, the textbook talks about that Canada has handled their banking very, very superbly, especially during the past decade when we've had some issues here in the United States. They've had a well-functioning system, strong balance sheets, relatively healthy households, and that they were able to recover quicker from our worldwide banking crisis. So that kind of gives you just an overview of all the general banks worldwide.